The number one question I get every single day is this. If XRP is supposedly the backbone of the next financial system, why is the price still sitting where it is while the world's largest institutions are quietly building on top of it? Let me pull back the curtain, because what I am about to tell you is not being explained to retail investors the way it should be. While everyone was staring at red candles and arguing about short-term price action, something extraordinary happened on the XRP ledger. Real-world assets just crossed $4.8 billion. 200 million RLUSD was minted in a single overnight transaction. The Reserve Bank of Australia just publicly validated the XRPL native decentralized exchange for sovereign bond settlement. And almost nobody is connecting these dots. The world missed the signal. Today, we connect them. Every single one of them.
Make sure to like, subscribe, and drop a comment below with your opinion on XRP, and watch until the end, because the final minutes reveal why July 13th could change everything. Welcome back. I am the Calm Analyst, and today we decode what I am calling the Great Convergence. The moment institutional infrastructure, regulatory clarity, and tokenized real-world assets all collapsed into a single ledger at the same time. Before we go under the surface, this is not financial advice. This is structural analysis. In this briefing, we examine why a specific date, a specific stablecoin mint, and a specific central bank pilot represent the quiet completion of a system that has been under construction for over a decade. Let's jump in. Let's start with the hard truth. 95% of people watching the crypto market are staring at the wrong screen. They are watching candles. They should be watching plumbing. If you are wondering why XRP's price action feels disconnected from the news flow, you need to understand a concept that the retail crowd has never been taught. Institutional infrastructure is built in silence, priced in noise, and revealed in catalysts. You see, retail investors look at a chart and ask, what is the price doing today? But financial institutions, sovereign entities, and central banks, they ask a completely different question. They ask, what rails will the next $25 trillion of tokenized value flow through? And right now, the answer is being written in real time on the XRP ledger. Consider what just happened. The Reserve Bank of Australia, in collaboration with a firm called ZeroCap, just executed a complete life cycle of a tokenized Australian government bond. Issuance, secondary trading, redemption, and atomic settlement, directly on the XRP ledger's native DEX. Not on a private fork, not on a permissioned sandbox. On the same ledger you and I can access right now from a phone. This is what David Schwartz has been quietly building toward for over a decade. This is what Brad Garlinghouse meant when he said Ripple was not playing the same game as the rest of crypto. The architects were never trying to win a meme war. They were trying to win the settlement layer of sovereign debt. And here is the part the mainstream financial press refuses to acknowledge. VanEck, a multi-billion-dollar TradeFi research house, just released a report explicitly framing the XRP ledger, alongside Canton, Providence, and a small handful of others, as the core infrastructure of what they call the corporate chain era. Their thesis is simple. Value capture is migrating from legacy rails to tokenized, business-built, regulated networks. And the XRP ledger sits at the center of that map. This is not a Moonboy fantasy. This is a Wall Street research desk telling its institutional clients where the fees of the next decade are going to be paid. Now, ask yourself the brutal question. If the infrastructure is being validated by central banks and TradeFi research houses simultaneously, what exactly is the price chart telling you? It is telling you the same thing it always tells you in the silent phase before a systemic reset. It is telling you that the smart money has not finished accumulating. Let's do the math that the retail crowd ignores. Real-world assets on the XRP ledger just crossed $4.8 billion. That puts the XRPL at number 4 in the global rankings, including stablecoins. Above it sits Providence at roughly 18 billion. Above that, Ethereum. The gap between XRPL and Ethereum is not measured in years anymore. It is measured in roughly $1 billion of additional tokenization. At the current pace of growth, that is a quarter, maybe two. Now, let me layer in the second number, 200 million RLUSD, minted in a single overnight transaction. This is the largest single mint in RLUSD's history. Think about what that means structurally. Stablecoin issuers do not preload that kind of inventory unless an institutional venue, a settlement corridor, or an on-ledger market has signaled it needs the liquidity now. That mint is not marketing. That mint is plumbing being pressurized before the valves open. And here is the math that should stop you cold. The cross-border payments market moves roughly $150 trillion annually. The Forex market moves $7.5 trillion per day. The global derivatives market sits at roughly $1.2 quadrillion in notional value. The tokenization wave that BlackRock's Larry Fink has been openly championing is conservatively estimated at $4 trillion over the next several years. XRP has a fixed supply of 100 billion tokens. Roughly 55 to 57 billion are in circulation. The rest sits in escrow, released 1 billion per month, with the vast majority relocked. So let me put this in terms anyone can understand. If the XRP ledger captures even 0.5% of the cross-border payments market, you are looking at $750 billion of annual settlement volume flowing through a fixed supply asset whose liquid float is shrinking every quarter as institutional custodians lock tokens into multi-sig cold storage. This is not a prediction. This is a requirement. The math demands a repricing for the system to function efficiently. Higher per-token value means fewer tokens needed per transaction, which means less slippage, which means more institutional willingness to use the rail. The architecture requires the price to move. If you have a problem with that conclusion, you do not have a problem with me. You have a problem with the laws of supply, demand, and liquidity efficiency. While retail investors are panic selling because of short-term volatility, the institutional signal has never been stronger. Let me walk you through what the silent actors are actually doing. Global ETF holdings of XRP have crossed 1.4 billion tokens locked. In the United States alone, we are approaching 900 million XRP held in regulated investment vehicles. These are not traders. These are custodians. Once a token enters a regulated ETF wrapper, it does not come back to the open market for a 10% profit. It is gone from circulation. The CME Group just celebrated 1 year of XRP futures. The numbers are staggering. 1.32 million contracts traded, $62.87 billion in notional volume, 28.6 billion XRP equivalent traded on a regulated institutional venue. Ask yourself, does the largest derivatives exchange in the world list a product and watch it generate $63 billion of volume in 12 months if the underlying asset is dying? Then look at the corporate chain map from VanEck. They name the XRP ledger. They name Coinbase's chain. They name Providence. They name Canton, which is JP Morgan's network. They name Robinhood's chain. This is the institutional roadmap, written in plain English, telling you exactly which rails are going to capture the fee revenue of the next financial era. And then there is Zero Cap and the Reserve Bank of Australia. Let me be clear about what Project Acacia actually proved. It proved that a sovereign government bond can be issued, traded on a secondary market, and redeemed at maturity using the XRP ledger's native DEX, with full programmability, full auditability, and atomic settlement using stablecoin rails. A central bank just publicly endorsed the XRPL as production-ready infrastructure for sovereign debt. Does a central bank participate in a pilot of that magnitude without absolute legal and technical certainty? Absolutely not. They do not gamble. They position. And consider what Ripple's own SVP of stablecoins, Jack McDonald, just confirmed. Every single RLUSD transaction on the XRP ledger consumes XRP as the gas token. The utility is abstracted away from the user, but it is not abstracted away from the network. Every stablecoin transfer, every tokenized bond redemption, every atomic settlement, they all burn a fraction of XRP. The more RLUSD scales, the more XRP demand is structurally embedded into the system. This is not retail FOMO. This is calculated positioning by sovereign entities, market makers, and custodians who already know what the next chapter looks like. Now let's talk about timing, because the calendar matters more than people realize. July 13th is becoming the most important recurring date in this entire story. On July 13th, 2023, Judge Annalisa Torres ruled that XRP in itself is not a security. That single ruling unlocked the entire institutional pathway. 3 years later, on the exact same date, the DTCC tokenization service began its soft launch. The Depository Trust and Clearing Corporation, the entity that settles virtually every American securities transaction, began its tokenization rollout on the same calendar date that XRP was legally cleared. History does not always rhyme. Sometimes it lines up so precisely that you have to stop and pay attention. The catalysts ahead are stacked. The Digital Asset Clarity Act is moving through Congress, and once it passes, the final regulatory risk premium on XRP evaporates. Ripple's pending U.S. bank charter, when granted, transforms the company from a payments firm into a regulated financial institution with direct access to Federal Reserve infrastructure. The Genius Act has already codified the stablecoin framework, which is precisely why Ripple front-ran it by launching RLUSD before competitors could lock in the regulatory moat. Each of these is not a maybe. Each is a scheduled inevitability. When the regulatory final switch is flipped, the wait-and-see capital that has been parked on the sidelines for years becomes all-in capital almost overnight. The risk premium vanishes, and the price gaps to where the math has been pointing the entire time. We are moving from an era of abundance to an era of scarcity, and most people are going to miss the transition entirely. Exchange reserves of XRP are at multi-year lows. Tokens are flowing from retail-accessible exchanges into institutional cold storage at a pace that on-chain analysts at firms like Glassnode and CryptoQuant have been quietly flagging for months. The float is shrinking. The demand pipeline is expanding. This is what a supply shock looks like before the chart confirms it. Once a token enters a multi-sig institutional vault, it does not come back to market for a 10% profit. It is gone. It is gone for the duration of the institutional thesis, which is measured in years, not weeks. When the final regulatory catalyst arrives, when clarity passes, when the bank charter is granted, when the next major sovereign pilot is announced, the retail entry window narrows dramatically. The institutions have spent years using volatility, FUD, and silence to shake out weak hands so they could take the position at a price that will look absurd in retrospect. The door is closing, not in a dramatic, cinematic way, in a quiet, structural way, the kind of closing that you only notice after it has already happened. I know it is tough to watch the chart in moments like this. I know the headlines manufacture fear. I know the silence between catalysts feels longer than it actually is. But as an analyst, I am trained to distinguish between noise and signal. And right now, the signal is overwhelming. $4.8 billion in tokenized real-world assets, $200 million in single-mint stablecoin liquidity, a central bank publicly validating the native DEX, a TradeFi research house naming the XRPL as core corporate chain infrastructure, ETF custody crossing 1.4 billion tokens globally, CME generating 63 billion in notional volume. Being early feels exactly like being wrong, right up until the moment reality catches up. And reality, in this case, is not a question of if. It is a question of who is still holding when the system completes itself. While the masses are focused on short-term price action, the smart money is positioning for the structural reset. While retail is asking, when does it pump? The institutions are asking, how much can we accumulate before the regulatory gate opens? The question is not whether you believe the thesis. The question is whether you have the patience to remain in position while the architects finish their work. If you're enjoying this deep dive, make sure to like, subscribe, and drop a comment below with your opinion on XRP, and watch until the end. Because the final minutes reveal why July 13th could change everything. Here is the bottom line. Price is a distraction. Infrastructure is the reality. The XRP ledger is no longer a speculative chain hoping for adoption. It is a settlement layer being actively used by sovereign central banks, regulated ETF custodians, the largest derivatives exchange in the world, and a stable coin operation that just executed the largest single mint in its history. The convergence is not coming. It is here. The chart is the last thing to acknowledge it, because the chart always is. If you made it to the end of this briefing, you are not part of the crowd. You are part of the informed. Drop the word convergence in the comments below. I want to see who actually understood what was just laid out. And if you value this kind of structural deep dive, subscribe, because the next several months are going to separate the patient from the panicked, and I want you on the right side of that line. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss. Calm analysis leads to victory. I am the calm analyst. The math doesn't lie, and the system is almost complete.